Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 19th of November. I'm Daniel Lam, your host for the podcast. I was watching this YouTube interview with two senior partners in a prominent hedge fund, which famously trains its trading staff through playing Texas Hold'em, because the game has many similarities with real-life trading. Now, from experience, the two pocket cards that you get dealt can change dramatically in value once the flop comes. The flop are the three cards that are dealt as common cards. Now, the possibility following these three common cards can alter the situation quickly, and you need to acknowledge the new phenomena. Now, as we said in a podcast last week, under Trump presidency, uncertainty is the only certainty. Well, recall that right after Trump's victory, Powell said that the FOMC would not readily change policy until the impact of fiscal actions was visible. But in his speech at the end of last week, he said that the economy is not sending any signals that we need to be in a hurry to lower rates. So in effect, he is acknowledging the new phenomena. Now, sure enough, the US 10-year government bond yield, which has shown signs of pullback last week, backed up again to around the 4.5% mark, is looking quite sticky around that level in the very near term, as investors are increasingly expressing their view of no lending via the bond markets. Now, interestingly enough, across the Atlantic Ocean, the situation is somewhat different in Europe. While the street is scaling back its Fed rate cut forecast, ECB policy rate expectations have been turning more dovish. ECB policymakers have highlighted downside growth risk from potential tariff in the build-up to the elections, and this is getting more prominent on the Republican clean sweep. Looking back to Trump's first term, such tariff concerns in Europe look well justified. Once the global trade war gained momentum, markets toned down their growth forecast in the euro area, and the PMIs moved into contraction territory. Moreover, under Trump's policies, European countries are likely to need to contribute more to NATO's defense expenses. These resources could have been otherwise used to stimulate their domestic economy. As such, this environment bodes well for European bonds, and we continue to advocate our opportunistic idea in long European government bonds. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.